Welcome to my YouTube channel. Today we will delve into the dark reality and uncover the secrets of the stock market.
Ever wondered how stock market manipulation works? It's the unseen mechanism that tinkers with the gears of the financial world, a game of shadows played behind the curtains of Wall Street. This clandestine practice, whether it's insider trading or pump and dump schemes, can disrupt the natural price discovery process and create unfair advantages. But how does it really work? And how does it affect you and me? Stay tuned to understand the ins and outs of stock market manipulation and how it affects us all. Stock market manipulation involves various tactics aimed at artificially influencing stock prices for personal gain. At its core, manipulation is a form of deception, a game of smoke and mirrors played by those who seek to profit at the expense of others. When we speak of stock markets, we're talking about platforms where securities are bought and sold. They are essential for companies looking to raise capital and for investors looking to trade. But when manipulation comes into play, it disrupts the natural price discovery process. This process is crucial as it helps determine the fair market value of a security based on supply and demand. When this process is tampered with, it can lead to unfair advantages for certain market participants, often leaving the average investor at a loss. Now that we understand what stock market manipulation is, let's dive into the different types. There are several types of stock market manipulation, each with its unique characteristics and consequences. First up is the notorious pump and dump scheme. This method involves artificially inflating the price of a stock through false or misleading statements. Once the price is pumped up, the perpetrators dump their shares at this inflated price, leaving other investors holding the bag. Next, we have insider trading. This occurs when individuals with non-public information about a company trade based on that privileged insight. This could involve executives, employees, or anyone with inside knowledge, leading to unfair gains. The third type is front-running. This is when brokers execute orders on a security for their own account while taking advantage of advanced knowledge of pending orders from their customers. It's like jumping the queue in the stock market, and it's just as frowned upon. Then we have churning. Picture this: a broker excessively buying and selling a security, not for the client's benefit, but to generate commissions. It's a bit like spinning your wheels. Lots of activity, but not much progress. Our fifth type is spoofing. This involves placing a large order to buy or sell a security with the intent to cancel it before execution. The idea is to create a false impression of demand or supply, influencing others to act based on this illusion. Finally, there's painting the tape. This is when traders create a false impression of a security's activity, often by coordinating trades with other manipulators. It's like creating a mirage of market activity that isn't really there. These types of manipulation have led to some of the most infamous financial scandals in history. Each of these tactics is a form of deceit, a way for manipulators to gain an unfair advantage in the market. It's crucial to understand these tactics, not just to avoid falling victim to them, but to promote fair and transparent markets for everyone. Let's take a look at some of the most notorious instances of stock market manipulation in history. First up, let's delve into the Enron scandal of 2001. This American energy company was once the 7th largest in the United States. But behind the scenes, Enron's management was using accounting loopholes and special purpose entities to hide debt and inflate profits. When this manipulation was exposed, Enron's stock price plummeted from a peak of $90 to a mere few cents, wiping out billions in investor wealth. The fallout was monumental, leading to the dissolution of Arthur Andersen, one of the largest audit and accountancy partnerships in the world, and significant financial and criminal penalties for Enron executives. Next, we travel back to the turn of the millennium and the dot-com bubble. This was a period of excessive speculation in internet-related companies. Investors, caught up in the excitement of the new digital era, ignored traditional metrics like earnings and cash flow, instead focusing on potential future profits. Many companies exploited this enthusiasm, making false earnings reports and exaggerated claims about their potential. When the bubble burst, trillions of dollars in paper wealth disappeared overnight. Companies that had been trading at sky-high prices became worthless, and even established tech companies saw their share prices tumble. Finally, let's discuss the subprime mortgage crisis of 2007 to 2008. This was a different kind of manipulation, involving not just individual companies, but the entire housing market. Banks and other lenders began offering loans to subprime borrowers, people who were unlikely to repay. These risky mortgages were then repackaged into complex financial instruments and sold to investors. When homeowners began defaulting on their loans, these mortgage-backed securities collapsed in value. The resulting financial crisis led to the Great Recession, with stock markets around the world losing about a third of their value. These incidents highlight the devastating effects of stock market manipulation, leading to calls for stricter regulation. As we'll discuss in the next scene, these historical examples have led to significant changes in how markets are regulated. But for now, let's remember the lessons of the past. Stock market manipulation can lead to catastrophic losses, and it's up to all of us to stay informed and vigilant. In response to these scandals, regulatory bodies and governments have made efforts to detect and prevent market manipulation. First off, let's talk about the Securities and Exchange Commission, or the SEC. This is the primary regulatory body in the United States tasked with enforcing securities laws and protecting investors. The SEC has the authority to bring civil enforcement actions against individuals or companies found to have committed accounting fraud, provided false information, or engaged in insider trading. Its aim is to ensure fair and orderly markets. Next, we have market surveillance. This involves the use of sophisticated technological systems by exchanges and regulatory bodies to monitor trading activities. These systems are designed to detect unusual trading patterns that may indicate manipulation. For instance, a sudden surge in a stock's trading volume could signal a pump and dump scheme. Once detected, these suspicious activities can be further investigated, with penalties ranging from hefty fines to imprisonment. Lastly, we have legislation. Governments enact laws to prevent and punish market manipulation. A notable example is the Sarbanes-Oxley Act, passed in the wake of the Enron scandal. This act introduced major changes to the regulation of corporate governance and financial practice. It aimed to protect investors by improving the accuracy and reliability of corporate disclosures. These regulatory responses form a multifaceted approach to combating stock market manipulation. They represent a combination of proactive monitoring, stringent enforcement, and the legal framework necessary to penalize wrongdoers. However, it's important to remember that manipulation tactics are constantly evolving, with fraudsters finding new ways to game the system. As such, it's not just about the regulators and the laws, it's also about us, the market participants. We need to stay informed, exercise caution, and report suspicious activities. Remember, maintaining investor confidence and market stability is not just the responsibility of the regulators, but all of us who participate in the market. Despite these measures, constant vigilance is necessary to maintain investor confidence and market stability. Stock market manipulation is a critical issue that affects all investors and the integrity of financial markets. As we've seen, manipulation tactics can range from pump and dump schemes, insider trading, front-running, churning, spoofing, to painting the tape, each designed with the intent to artificially influence stock prices for personal gain. Historically, we've witnessed the catastrophic fallout of such manipulative practices. The Enron scandal, the dot-com bubble, and the subprime mortgage crisis are stark reminders of the damage that manipulation can cause, not only to individual investors, but to the global economy as a whole. Regulatory bodies, like the Securities and Exchange Commission, market surveillance systems, and legislation have been put in place to prevent and punish market manipulation. Yet as technology evolves, so do the tactics of manipulators. making vigilance and awareness key in maintaining market integrity and stability. As investors, it's essential to understand the signs of manipulation and to be aware of the various tactics that can be used. Staying informed and vigilant is not just about protecting your investments, it's about maintaining the fairness and integrity of the financial markets that we all rely on. So as we navigate our investment journey, let's remember the importance of knowledge and awareness. Remember, an informed investor is a protected investor. Stay informed, stay vigilant, and stay successful in your investment journey.